Hi everyone, welcome to your Daily 5 Stock Charts TV. I am Mish Schneider, Chief Strategist of marketgauge.com. Going to have a discussion with you today on should you be commodities heavy? What's so interesting is that those of you who know me know that I have been all about commodities really basically since the pre-COVID. And now there's really a distinction between commodities and equities, and obviously you can see that certain commodities are doing well while others aren't. And a lot of it, of course, has to do with the current geopolitical situation. But it still begs the question of, are we still entering a super cycle, if you will, something that we've been predicting could happen? And of course, this would all be in the face of the yields that have been much higher, with the possibility of maybe some kind of a shift there based on a lot of Fed speak in the current week. And also, of course, the idea of the dollar still being relatively strong, although I don't think it's quite as strong as it could be or should be, all things considered. So this tells me that we have layers of reasons why commodities could be the thing. Besides the geopolitical situation, besides the fact that we could be over the headwinds of the higher yields, also the fact that the dollar could actually be kind of at risk. And then, of course, we have some other reasons as well, which we'll talk about as we get to the charts. And there's so many commodities to cover, but just considering time, we're going to look at ETFs, not futures. I can talk future prices, but I want to look at, obviously, GLD, SLV, the miners, wheat, and DBA, Bitcoin, because right now we're seeing it kind of a store of value, oil through the USO, and of course natural gas through So let's get started. So if we begin with gold, we know right now that spot and December contracts are trading at around $2,000 an ounce. And I've been talking about gold a lot, obviously, over the course of really a couple of years. And that this spectacular dip that we had, if we look at the daily chart here, I have the daily and a monthly up to gain perspective. We always talk about the fact that gold always looks, when it looks the worst is the time to buy, and when it starts looking good, it's the time to sell. Until the time when it starts looking good, no one sells, in which case that's when you're going to get your parabolic move. And that's kind of where we're at potentially right now. What we can see right here, obviously, is, first of all, we've broken down under the 6-month calendar range low. We're now back above the 6-month calendar range high. Clearly, you can see this is a risk-off environment with it outperforming the SPY. And in terms of momentum, yeah, it's good we cleared the 50, but we haven't cleared the 200 yet. So that tells me that we're back above the 0 line, a positive, back above the 50, a positive, but we're at the Bollinger Band and resistance here. So we still have one more level of momentum. And once that momentum, if that momentum actually gets stronger, then you can count on this parabolic move. And I started out this year at my Outlook 2023 saying that I thought that gold could get to 3,000. Of course, I shudder to think of the reasons why that would happen, but nonetheless, as a trader, we have to separate that and say it's possible. And here we have this monthly chart. So we've had a lot of consolidation on the monthly chart on, let's call it the right shoulder with a head, and now the left shoulder. So really, if you just want to look at it on pure monthly closes, not wicks, but pure monthly closes, if we got a close in GLD over 186.37 as we end October, I think the writing is pretty much on the wall. Now we have to look at silver because there's a couple of reasons why silver is so interesting. Number one is, in an inflationary environment, you want to see silver outperforming the gold, and yet it really has not been at this time, although it could start. So right now we can say more that silver is being dragged up along with gold, and yet the fears of inflation haven't really fueled yet. If anything, you're hearing people, because of Europe and Germany, talking about disinflation. But again, I will maintain that they are looking for inflation in all the wrong places. And one of the biggest reasons why inflation can ignite besides the geopolitical situation, that is the obvious one, would be if yields soften and the dollar falls. Because what that would tell you is not so much the pure play of yields versus precious metals or dollar versus precious metals, more of another unraveling, and that would be, does the Fed really have control of the situation? And part of the situation, of course, is the massive amount of spending that is going on to try to ameliorate the issues of the world and our own lack of oil supply. But that's a whole other story we'll get into momentarily. This would be an accumulation phase because we still don't have the 50 back over that 200. And we got through that 6-month calendar range low, but clearly you can see we have room to go. In terms of the actual futures price, I would say $24 an ounce has been resistance. We get through $24 an ounce and we're getting close. Then I would say we're well on our way of testing some of these higher levels here, outperforming, of course, the SPY. And in momentum, not quite as strong as gold, still needs a little bit more push in the momentum. But trust me, that could happen very quickly because these are commodities, and as we know, they're extremely emotional. The monthly chart, not quite as pretty as gold in terms of some kind of an inverted head and shoulder, so let's not even go there. Let's talk about the fact right now that we've established this incredible support after this dump here in 2022 above the 80-month moving average. And now we haven't really spent a lot of time under the 23-month, but now we're back above it. So we certainly didn't get 2 months in a row. That gives you that 2070, I like to call it 2050 now, as your key support, only $1 away. We get through that 23, you can see that particularly as we end October, off she goes. Now, let's go to GDX. Okay, so people are saying, well, if it's so bullish in the metals, why are the miners underperforming? And I guess that's a kind of a legitimate question. Typically in an inflationary environment, kind of like what we just talked about with silver, excuse me, we can see that people haven't really been worried about that. But again, for all the reasons I just spelled out, no need to repeat, that could actually occur. In which case, like we've seen in the past, the miners can play serious catch-up. So right now what we have is over the 50-day moving average, again, outperforming the SPY. Momentum doing good as well, not quite as strong as it could be, but could turn out to be. I think what's really interesting here is this monthly chart, where we really saw the underperformance to gold. Now is starting to clear above this, like let's call it 30. And again, October close over 30. I think the writing is on the wall there. So people say to me, but Mish, what about food? People are talking about food inflation, yet we're not seeing it in the futures price. I say we're not seeing it yet, although if you look at DBA, by the way, which we will momentarily, it's clear 22, which to me was sort of like the holy grail of places it has to clear and hold above. But I thought wheat was kind of interesting here because it looks like we're experiencing a reversal. Number one is it is now also outperforming the SPY. And the momentum here is in exactly the opposite of what we just saw with the metals. This is in a bullish divergence in that the 50 is above the 200. Momentum is clearing not only both of those moving averages, but starting to clear the Bollinger Band. And the last time we were at these levels in the Bollinger Band, wheat was trading up at around 668, 675. So I think we're starting here with wheat. We could catch a real serious bid in the wheat. We have to get through the 6-month calendar range low. Then, of course, the 200 and the 6-month calendar range high. But it definitely merits keeping an eye on. The monthly chart, of course, has been broken down and showed more of a negative long-term cycle under the 80-month. But it also held these 2020 levels after we had the big dump on before the COVID, after the COVID, it's holding there. So you can say 550 is really your support. And this would be another one to keep your eye on. But I want to look at DBA. And with DBA right now, look at the monthly chart on this one. So wheat is just one component. Of course, sugar has been sitting around this 27 cents, and that also looks like it could potentially take off. But DBA is really looking like the conglomerate of all of the different soft and agricultural commodities as it's ready to scream. We have not had a monthly close, and let's take a look here. The monthly close on this particular period of time was right around 22.10. We have not had a monthly close above 22.10. We have, I should say ever, but certainly not in recent times. We get a close over 22.10, then I think that's also going to be your writing on the wall. And if we take a look at the daily chart here, your momentum is lagging. So that's something that could catch up. Clearly, the leadership here against the SPY is palpable, and we're above both of the moving averages and the 6-month calendar range high. So I also want to move into another asset class here, because I've just been going to these spaces where we've had these huge conversations about Bitcoin, and whether or not Bitcoin is a store of value, more like a commodity, more like an asset class, what's the story? So right now, it's acting more like a commodity and a flight to safety. My particular theory is that at some point that will change, where it'll become more integral to the consumerism in the banking industry, which can actually wind up being replaced completely. But be that as it may, I am jumping ahead because we're probably a while before that happening, but maybe not as long as people think. Anyhow, we're clearing the 23-month in Bitcoin right here, but we still have to get through some stuff, right? This month here in June, it closed a little bit over 30, and we have not had that close over 30 in a while. So that tells me we had a high of 31.4412 that month, but we closed underneath that. So we have to get a monthly close over 30 for this to start really be screaming. Yet on a daily basis, you can see it here. We're just now getting back to the 6-month calendar range high, another outperformer, and another laggard in terms of momentum. So it's kind of like following maybe sort of more the softs path than the precious metals path, which means right now gold and silver is still superior in essence to the Bitcoin as far as a commodity and safety value. But that doesn't mean that this could also join from a completely different perspective. Okay, last couple I want to show you is USO. So we know oil in terms of WTI oil, crude oil, 90 is a big area for us. 80 was the bigger area, but now 90 is coming into play. And at last check, WTI spot or December contract was trading at like 89.70. So we're darn close. But again, to me, this is so bullish because we have over the 80-month, which it hadn't been, if I just scrunch it up here, except for this period of time after COVID when things exploded and then the rates kind of got in the way, we have not been above the 80-month moving average. If we kind of just sort of project this out, since 2008, since October 2008, the big crash. So we are now, while so many instruments like the small caps, for example, are breaking their 80-month moving average and going more into a bigger downtrend, oil is showing a bigger uptrend. And that may be the best case of everything I've told you why a super cycle is imminent. And I don't care what's happening in the U.S. Yeah, now we're saying we're going to buy back our oil at $79 a barrel. We're going to try to make deals with Venezuela, lower the sanctions, et cetera, et cetera. The point is that in a geopolitical situation like we have now, or in any kind of stockpiling that can happen anywhere during rough times, or if interest rates comes down, or the dollar comes down, whether it's priced in dollars or not, this is all going to be bullish for what we know is a low supply, and that is oil. So in terms of numbers, here's the daily chart. Clearly, we haven't had a move above this 82, 86 close, so let's call it 83. I feel like at this point now, we shouldn't break down under 76.50. That would be really kind of my line in the sand. And again, since we looked at it from a daily perspective, if we look at it from a monthly perspective, a monthly close over 85 in USO should really seal the deal. Now, the last one we're going to talk about here is natural gas, because natural gas was looking like it was getting ready to explode. And then some mild weather came along and everybody's like, okay, who needs natural gas? Also, there was a whole issue with the Finland pipeline, and now there was news that came out that actually the U.S. and Canada might be working on extending some kind of pipelines here. But that's all good, and that's why we can see this at current levels right now. However, it's still been, albeit wide range, it's still been in a range. It's the only commodity I've shown you that is underperforming the SPY. So the first thing you may want to watch for is to see if it starts to outperform. The second thing you want to watch for, if you really want to clear all the resistance and be conservative, you'd want to see this clear, let's say, over 8. Over 8 would also take it over all of this work that we've had over the last several months. And you don't want to see it break down under this low right here. So at this point right now, I would say with this gap lower, that's probably weak. I would look for what happens on Monday. If this gap holds, and let's say we gap back up, especially if we gap back up over this level right here are the lows of the other day, which is 690. We gap up over 690 on Monday. I would probably say you have a pretty tight risk. And again, if you want to really wait, you can wait at least for it to clear the 6-month calendar range high, maybe even the 200-day moving average. And if you really want to be ultra conservative, then you want to wait for it to clear 8. So that's kind of I hope, a nice round picture of commodities right here. Remember, we can even get a pop in equities. It doesn't matter. These are definitely trading on its own fumes. And like I said, if the rates fall or the dollar falls, this is only going to goose the hyperinflationary story, even if it helps equities in the short to intermediate term. Okay, that's it for now. Hope you all enjoyed. Thanks so much for watching. Have a wonderful weekend, and bye for now.